In this video, I want to talk about the BRRRR method, BRRRR, buy, rehab, rent, refinance, and repeat. And the fun part about the repeat, that's not just some symbolic word. The fact that you're pulling money out, hopefully at the appraised value, so you can get your money out and start doing more deals and more deals, that is a true repeat word, not just something that you're saying, hey, you learned how to do this, you might as well do this more than once, more often. No, you are pulling money out so that you can actually repeat. So let's go over each of these acronyms here. The B is buy. You want to buy right, and you're buying properties to rehab here. That's the whole process and the principle. So we need to be buying properties right. Now, I'm going to just talk in general numbers here. You can shift this for the price ranges and the areas and the time of the market. But what we want to do, we want to limit your downside, your risk. So a 70% after repair value, ARV, including the repair costs, you don't really want to go over that, because if the repair costs are more, that eats into this whole BRRRR method. So that's first and foremost. Once you've got that property, you want to rehab that property. Now, as you are looking for properties to rehab, you want to be looking for the types of repairs that are going to add value into that property, because of course that's what is so great about real estate and about rehabbing, because you can be adding value to that property. You see it on the shows that are out there where people are rehabbing properties. They are going in and they're remodeling, they're updating, especially when the properties are old, when they've had deferred maintenance, the interior, when they go in, you think, oh gosh, that is so dated. And then once they're done, it's incredible. Now, they're obviously selling to an end buyer, and in this case, it is a rental property, so you don't have to go in there and be putting in granite and all these grandiose things. But the point is, if you can be finding a property that needs a new kitchen or landscaping or drywall, things that, don't take a whole lot of money, in the case of drywall, certainly the other things can take a lot of money, but if you can be having repairs that you manage those costs, but at the same time, they're adding a lot of value to the property, that is a good thing. So you want to be buying right, staying within that ARV of 70 or below, including the estimated repairs. You want to be looking for properties to buy and rehab that those repairs are going to be adding value into the property. And then you want to rent that property out, because a lender isn't necessarily going to want to refinance that property without a tenant in there. Now, when you're renting out, you always want to screen well, and you want to make sure before you buy a property in any area that that rent is going to support the overhead of that property. Principal, interest, taxes, insurance, homeowners associations, anything along those lines that you're going to be paying, you want to make sure that you've got at least that, if not more. Now, obviously, the 1% rule that's out there, if you've got properties that are very affordable, that is something to consider. That's when you're buying the property at, say, $100,000 and you're able to get $1,000 a month rent. And of course, you got to work in to that taxes, insurance, homeowners association, all those sorts of things if they apply. That is a rule of thumb. But what happens if you get over, say, a $300,000, $400,000, $500,000, $600,000 house, and you still want to do something like this? Obviously, that 1% rule isn't necessarily going to always work, right? So other things come into play, but the numbers will always tell you if it's a good deal, if it's something that you want to be going forward on, or if it's not a good deal. If it gives you that feeling inside after you've crunched all the numbers, okay, something's got to be different. So we always want to screen well. We always want to make sure that that property in that area is going to support the debt and any other overhead. Plus, of course, if we can have some padding, that's good too. And then when it comes to refinancing that property, we want to find lenders that will allow us to pull a lot of money out, because, like I said in the beginning, we want to repeat this process. So we want to make sure that they are refinancing based on appraised value, not just the debt, because you have done your due diligence when you first bought this property. You've bought it right. And then, of course, you put in a lot of value with the rehab. So we want to find lenders that will allow you to pull the money out based on the appraised value. Some lenders require a seasoning period based on how long you've owned that property and if they will loan the appraised amount or how much you've got invested in the property. And these days, some lenders will loan up to the appraised value once the property's been rehabbed and rented out. I bring that distinction up so that you know if you are reaching out to a lender that says, nope, we don't do that, we require a seasoning period, say, all right, and then keep looking for lenders that don't have that kind of seasoning period, because you need to refinance at the appraised value. All that money that you put in, all of the value you put in, hopefully that's got a much higher appraised value than the money that you originally bought that property for and put into that property. That is essential for the BRRRR method to work. So we've got the buy right. You're staying within that 70% ARV, including the estimated repairs, so that if they go a little bit higher, hopefully that's going to be all right. That's just a general rule. You've got the rehab. You're putting value into the rehab that you're doing without breaking the bank, because you're not trying to build some luxury house here. You're just trying to make this a livable, nice home that somebody's going to want to rent and enjoy the process. And at the same time, the improvements are valuable. You then have the refinance, where you're able to hopefully refinance at that appraised value. You don't have any seasoning issues to deal with, so you can get that money as quickly as possible. And then, of course, you've got the repeat. You've got the repeat because you're pulling that money out so that you have the money to do another deal, to do another rehab, and you go on and on and on. That is the BRRRR method. I hope that helps. I'll share more with you in the next video.